Well, good afternoon and welcome to the Spheria webinar on what reporting season taught us for the outlook for the Australian small and microcap market. My name's Mark Cormack from Pinnacle Investments, and Pinnacle are equity partners and work alongside Spheria to distribute the Spheria small and microcap funds to the Australian financial advisory marketplace. And joining us on today's webinar are both founders and lead portfolio managers of Spheria, Marcus Burns and Matthew Booker. As a bit of background for our new listeners, Spheria are an independent fund management boutique who specialise in micro and small cap investing. And since establishing the Spheria Microcap Fund, the team has delivered a 21% total return and over 13% alpha in a very tough market for microcap investing. And the Spheria Australian Small Companies Fund has delivered a total return of 11% and over 7% outperformance versus the ASX Small Ordinaries Accumulation Index. Since our last webinar, Spheria was nominated and a finalist for the 2017 Emerging Fund Manager of the Year at the Lonsec Awards. And as most investors will know, the small and microcap space is a very specialised area of investing. So it's not often that you do get the opportunity to invest with such a highly experienced investment team who have a proven track record of delivering outperformance. Before we kick off, just a couple of quick housekeeping items. Today's Spheria presentation will last around 15 to 20 minutes, and that'll be followed by a Q&A session. And all attendees have the opportunity to ask questions via the chat box at the bottom of your screen. So without further ado, I'm going to hand you over to Spheria portfolio managers Marcus Burns and Matthew Booker for today's presentation. Thanks, guys.
Thanks, Mark. It's Matthew Booker speaking. I appreciate your time today. We're just on slide 2, just talking about Spheria at the moment. We now have nearly 400 million under management. We saw good support from institutional clients at Schroders who came across 2 of those clients, and obviously we've had good support from the retail market. The funds have performed well. It has been a difficult market to generate alpha if you look at our peer set, and you can see that we've generated good returns in both funds over 1 year and since inception. We actually think there's good opportunity in the market, and we're going through an iteration process now after result season and trying to find good ideas, and we'll talk about that further in the presentation. What we're finding is we're actually getting good access to companies. So we've had a lot of good meetings. We're still in that meeting process period, so we've seen a lot of companies in the past month or so, and that will continue over the next week or two as you stretch that result period into mid-September these days. For example, AWE, we saw the chairman 2 days ago and 2 of the board members, and today we had a one-on-one with the management team. So we're getting good access to companies. Moving on to slide 3, what you've seen since our last webinar, and we talked about this at the time, that microcaps were under a lot of pressure going into March, April. We've seen a rebound in that microcap space. You can see the Emerging Companies Index has actually rallied very strongly. We've benefited from that. The Small Companies Fund has been positioned down the spectrum into microcaps, so it's seen a benefit from that, and you can see that in the performance numbers. The actual small cap space hasn't rallied as much, and that we think provides quite an opportunity. If you look at the large cap space, it is very expensive. We look at the mid cap companies, we look at the large cap companies, and they look very expensive to us. So we think there's still some good opportunities in that microcap and small company space. We move on to slide 3. I'll pass on to slide 4. I'll pass on to Marcus to discuss that.
Thanks, mate. So Marcus Burns here, the other portfolio manager on the Spheria funds. So we're also here to talk about some winners and losers over the reporting period. Obviously, it was a fairly volatile period as the market saw numbers coming through, or in some cases failing to come through, and we saw some very large reactions to share prices, both positive and negative. And we always find that this period gives us typically a good chance to go through, especially when stocks materially underperform. If there's only a small downgrade in stocks, get sold off aggressively with a big change in sentiment. We often find during this process we can pick up some great stocks that have good balance sheets and good cash flows and might be missed to see by the marketplace. So some of the winners over the last month are in this chart here on page 4, and you can see there's some very large moves in things like Star Pharma and Highfield Resources. And also Blackmore's had a very good period. The stocks in dark green, they're the ones that we actually have in portfolio. Typically, stocks like Star Pharma and Highfield, although they had a great period of performance, in both cases those stocks don't generate cash flows. and so they're not in our portfolios. We do require cash flows as a core ingredient to how we think and invest, and we find that over the long run, stocks that don't generate cash flows whilst they have these periods of strong performance periodically. Over the long run, if you don't generate good cash flows, to support valuations, they tend to come under pressure. Go back and look at previous presentations. We had another stock last time that also had very good performance, had no cash flows in the biotech space, but subsequently in a very, very poor period of performance over the last 3 or 4 months. And stocks like Class Limited, which has been a core holding in microcap and small cap funds for a long period of time, had very strong results, backed up by good cash flows and a very good balance sheet. And that stock, we believe, will continue to perform very well in the medium term as it takes share in the SMSS space. And then finally, Vita Group, rounding out the top 3 there that we own, had reasonable sort of figures, but more importantly, gave clarity around the Telstra contract. And I think the market rewarded the stock a bit because it actually realised that long-term margins were sustainable around the 3-4% level, and the stock sort of bounced out of those results.
Thank you, Marcus. Just moving on to slide 5, and just looking at the losers over the month. And I'll say this: we will make mistakes. The average fund manager probably gets just over 1 in 2 right. We hope to get more than that right. We hope to be better than mediocre, but we will make mistakes. If you look at that chart, you can see that there were some pretty dramatic falls in the Small Ordinaries Index over the month, and usually that related to either a profit warning or a poor result. Clearly, CSG, which is a printing-related company, is one that we wouldn't invest in. It doesn't generate any cash flow. Basically, it plows it all into rolling out more printers to its customer base, and then trying to support those customers and selling products on the back end of that. It's a business we don't particularly like. GBST, on the other hand, is a business that we've looked at in the past and we've shied away from. It does generate good cash flow. It has a good balance sheet. It seems to have some good core competencies in the software it produces, but it is facing a lot of challenges in that UK market. So it's one that we've got a watching brief on, because it does tick a lot of our boxes, but it did face some significant issues during that period. One company that we did own that came out with a profit warning was Isentia Group, and it is a company that we think has strong fundamentals. It has faced some significant headwinds in the short term, particularly from one of their competitors. It appears that competitor has been stealing information from Isentia, and that's going through the court system at the moment. A favourable ruling on that front, and we believe that it's moving favourably, would mean a significant uplift potentially in Isentia's earnings. So we're still positive on the company. Isentia dominates the space it's in. It has the best product, but it is facing some competition. But that competition is on pretty shaky foundations.
And actually, the competition has admitted to having an account and siphoning information off through their own accounts to their own client base. So we think there's good grounds that Isentia has there for that reason.
Yep, it is a company that produces good cash flow. Cash flow has good market share and has a strong balance sheet. So we think the outlook will improve for that company. But there are a few companies in there. You can see that there's a few roll-ups in there which are souring, and invariably roll-ups do sour. So we are cautious on buying into companies that roll up assets. Generally the underlying trends are not that positive, and they buy assets to cover up those underlying trends. So a Hansen and Automotive Holdings, those are the companies that fit that bill, that have made a lot of acquisitions and we think could come unstuck. Just moving on to the next slide, it's slide 6. Just looking at a company, we owned Blackmores at our former employer. We owned it for a long time, I think from around $18 upwards, and we sold down that position into strength over the years. We did have a small position in the funds at Spheria. We've owned that for a while. We have been a bit cautious on the outlook for the company. They have faced a number of headwinds in the core business. However, we think a lot of the issues have been execution related. If you look back through the history of the company, it has been a very strong cash flow producer, so it ticks that box for us. Obviously, it has a very strong brand and a very strong market position in this country. The biggest issue we have with the company is it is under-earning. It's generating margins of around 12%. A lot of its peers generate much higher returns, and some of those peers are inferior. We think, BWX is an example of a company that owns the Sukin skincare range. It produces EBIT margins of 35%. It has the same distribution channels as Blackmores. It has less scale. It only sells $72 million of products a year. versus a Blackmores, which is selling $700 million in products a year. We are surprised that hasn't been action in the past to improve the performance of Blackmores. We think the new CEO hopefully moves it down that path, and we see a better outcome for Blackmores down the track. This can't go on forever. The company at some point will have to generate better returns. Otherwise, there will be actions taken by shareholders and the board. Even Goodman Fielder generated margins of 13% as a listed entity. I mean, Goodman Fielder sold some pretty inferior products through the supermarket chains. We see Blackmores as a much superior product in that market. So we've got a very optimistic view on Blackmores. We think they can turn it around. We think sales to China will continue to grow, and you will see some operating leverage out of the business. And we believe it is significantly under-earning at the moment.
Thanks, Matt. And on page 7, we just talk about Beacon Lighting, which is another retailer we've spoken about before, I believe, and one we've had again in the funds for some time. And also, a bit like Blackmores, we bought the stock in the IPO probably about 2 years ago. And we think we do look at businesses that we think are competitively advantaged, and stocks like Beacon Lighting, in our view, do tick that criteria. You can see on the left-hand side there our classic free cash flow chart we generate for all our investments, all models we do. And again, free cash flow Beacon has been historically around the 74-75% level, which is solid. The balance sheet's not very geared, and on the right-hand side of that chart, you can see this is a chart from their prospectus they put out a couple of years ago, but it still holds true today. That the 61% share there demonstrates how much of the advertising spend in the category that Beacon Lighting has. So Beacon has roughly a 20% share of the lighting category by sales, but spends almost 2/3 of the entire advertising category by marketing spend. Now, we think that gives them a real advantage over their peers. They've got a massive share of voice in that space. They kind of really own that space in terms of the consumer's mind. The stock got sold off pretty heavily in the first half of the year on fears that, one, property downturn was going to affect all these stocks. 2, weak consumer, and 3, obviously Amazon, the great Amazon is going to come to Australia and wipe out all retailers. Now, we understand Amazon's a fantastic business. We believe in Amazon, but we also think that the stronger retailers domestically will adapt and survive. And Beacon, who do their own sourcing, we think will be a very strong business for many years to come. In fact, could actually use Amazon as another form of distribution. In some cases, people own their own brands and supply chains end up selling their own product or a product made for Amazon through the Amazon marketplaces. So it's possible that the two will actually coexist symbiotically. And Beacon really forms one of the 2 or 3 names we bought in retail, Matt, over the last quarter or so that have rebounded pretty strongly. So names like Adairs, we also own the funds, that also traded well through this results period. People sold it off again on the fear that Amazon would clobber them and had a weak trading period back half of last year. But we saw a business that was pretty solid. Again, controlled by destiny because it controlled sourcing from Asia right through to the shops without paying any independent brands. And it's had pretty good results back of trading pretty well in the second half of the year, and it's bounced quite nicely. So we try and go through, look at cash flows, look at valuations, and try and look through the noise and find opportunities. I think that's why Matt flagged earlier that we're seeing opportunities now in the marketplace that many people think is pretty fully priced. It is pretty fully priced, but within that, there's been quite a lot of movement at the share level, and we're seeing that generating some good ideas in micro caps and small caps for us.
Adairs is an interesting example because it listed 2 years ago with much fanfare at $2.50, came out of private equity. It might have been $2.20, but its margins at the time were 15%, so it was generating EBIT margins of 15%. 2 years prior to that, it was generating margins, I think, around 10 or 12%. It might have been even lower. And so they really picked the time to list it. It was right at the peak cycle in terms of sales and margins. What you saw post that is the business came off, so sales slowed, margins came down, and they got to a point where the market was factoring margins of probably mid-single digit in the share price.
Yep.
So we bought a big stake in that company. It is a well-positioned franchise in that space. It is taking market share from its competitors. They've got a very loyal customer base, and it generates good cash flows. So we've seen that bounce considerably since we bought it. And obviously now the market is factoring in higher margins, but we think those margins will go higher than where the market anticipates.
And that's one of the reasons that many, including us, are very sceptical about IPOs, particularly from private equity groups, where they're very clever at picking a good time to sell a business. and typically they're picking top of the cycle, either with earnings growth or multiples or margins, or all three. And so maybe they're good companies, they're IPOing often at the wrong prices. So the outlook, turning to page 8, is that as we've kind of flagged during the presentation, we've seen quite a bit of volatility over the last month with reporting season, and we think that in many cases that's kicked up a couple of interesting ideas that we're chasing down now post results as we meet companies and doing more models. And there's a couple of names there that are coming through that we think are attractive and will build into portfolios. Long-term companies that are speculative in nature. And by that, we mean stocks that don't have fundamentals to back up the movements in the share prices. We think that over the long term, interesting stories or high growth rates with that cash flow to back them up will ultimately come under pressure and not prove to be good investments for clients and investors. We are consistently wary of roll-ups because the roll-up stories usually end, and or they pay high prices, or they're relying on constant M&A, which is fraught with risk in our opinion. And invariably they do come under pressure, so we're cautious on those kind of stocks. And then lastly, we've flagged retail sectors being a sector we've bought back into in the last few months and made reasonable returns on. We still see some valuation support to the retail space, but commodity prices have started to improve. Not just gold, but iron ore has been pretty strong. Copper, even nickel, even nickel of all commodities, has finally had a bounce. And we think that there's some interesting opportunities in some of the resource stocks. We are careful about which ones we buy, or resource-related industries. So in some cases, the second derivative of resources, being the mining service companies, can be occasionally very good, interesting opportunities for us to buy into. So Matt, do you want to summarise performance?
Yeah, slide 9 just tells our performance. As I said before, we have traversed a difficult market. I think our peers generally have struggled. We are finding good ideas. So we think our portfolio is shaping up pretty well. The companies we're buying have good cash flow. In some cases, the multiples have fallen, which means we think there's less risk. And so the outlook for our funds, it looks good.
Fantastic, guys. And look, thanks for that update. It's always fascinating to get your insights on the small and micro cap market, both in terms of what's happened in reporting season, but also what to look out for and what parts of the market to avoid. Just a reminder, all attendees have the opportunity to ask questions via the chat box at the bottom of your screen. While we wait for some questions to come in, I just thought I'd update everyone on research house ratings and platforms and dealer group availability. So currently the Spheria funds are highly recommended with Lonsec. They also have a recommended rating with Zenith. Recently, the Spheria funds have been added to the MLC and Navigator platforms for any of you who use that platform. And the Spheria Small Companies Fund was also added to the First Wrap platform. While we wait for a couple of questions to come in, one has come in. Guys, because of the cash flow focus, do many of your investments get taken over?
Oh, thanks, Mike. It's a good question, and I think we've flagged that before. That often the criteria we're looking at, so cash flows, good cash flow generation, not too highly geared, and obviously what we think is an appealing valuation. They happen to be the criteria that many private equity and or foreign companies are looking for when they make acquisitions. And so in the last 3 or 4 months, Matt, we've seen probably 3 takeovers of stocks we've owned.
Royal Wolf was taken over, and SMX, which is an IT company. And then previous to that, Fantastic Furniture was taken over. The interesting thing for us, coming back to Blackmores, it is a good cash flow generator. It is under earning. If Marcus Blackmore ever decides to sell his cornerstone holding, this thing would go for $200, $300. It is just so inefficient. Anyone who ran it more efficiently could make a mozza out of it. So yeah, we do get that. We do get that effect in our portfolios.
Excellent, guys. Another question here. Glad you met with AWE. Any thoughts initially after the meeting? I know you guys normally wait a little time before you make any decisions after you meet management, but any initial thoughts that you can share?
Yeah, we already own AWE in our funds. We think the Waitsia project is compelling. Now, obviously, they need to fund that, and the balance sheet is a bit stretched at the moment, so that is an issue. They're also awaiting that milestone in terms of getting the offtake agreement in place. They currently have 15 terajoules locked away, and they need to lock away 65, basically. Once that offtake arrangement is in place, and we think that timing of that could be November, the prospects of developing that asset are very good. And obviously, once that milestone is hit, it potentially becomes prey for a suitor, because it is a very, very compelling project. The IRR on that project is very good. The duration of the reserves is well in excess of 10 years. I mean, this could be a 30-year project. It's close to infrastructure. The capex is very low once they get over the hump of the plant, and also it is a conventional series of wells, so they don't have to frack, and that's critical. Obviously fracking is being banned, or is in the process of being banned in WA. They don't have to frack.
Excellent. Okay. Just a clarification. When you guys were talking about Blackmores, did you say BWX was a better option than Blackmores, or not a better option than Blackmores?
In our opinion, we think Blackmores is a better option, and the reason, in our view, is simple: is that BWX has a good brand, but it's got very high margins currently. And the point Matt was making in the Blackmores slide is that Blackmores has got a lot of revenue and comparatively low margins, and we think the margins should be a lot higher at Blackmores, and we think the margins at BWX are very full. Not saying they'll fall short term, but in the long run, they seem very high to us. So we think, therefore, on a relative basis, Blackmores is more appealing.
Yeah. I mean, you've got, as Mark said, you've got BWX earning 35% margins on 70 million of revenue. You've got Blackmores with $700 million of revenue,
10 times the size,
with 12% margins.
10 times the size, a third of the margin. Just doesn't make sense to us.
So there will be mean reversion.
Excellent. Okay, guys. I'll combine a couple of questions here because we're getting a few in. Any surprises during reporting season, positive or negative? And do you see any areas of risk in the small and micro cap market?
There's always risk in the small micro cap end. As we discussed before, there's a lot of companies which are burning cash and they have big market valuations. So, for example, we mentioned Star Pharma and Highfield Resources. Both companies burnt $28 million of cash in the past year, and they have market caps of $370 million. Now, that seems unsustainable to us. Maybe there's a good product at Star Pharma, but there's a big leap of faith in getting to that positive cash flow basis. With Highfield, it is a resource company. Maybe when it's burning cash, it's the best time to buy it.
Excellent, guys. Have any thoughts on Mount Gibson considering its recent price rise?
It's about time. Look, sorry, I couldn't put it quick. We've had Mount Gibson in the funds for quite some time. Since we had Spheria and obviously in our previous shop, we were also invested in Mount Gibson. It's now trading at about cash backing, maybe a tad under cash backing. So you're not quite being paid as much to take the shares. But our view is that the cash is real. It's not going to be wasted. Management has had cash for a long time on the balance sheet and been judicious about the use of the cash. To us, the project at Koolan Island looks interesting. So they're restarting the main operation at Koolan Island, which has got good resource, high grade, and a 5-year life or so, and low cash costs. So we think it's very appealing. Yeah,
we think the reopening of Koolan Island is actually compelling. As Marcus said, the grades there are high 60s versus average ore at 62%. So they get a $30 premium on top of the 62% iron ore, which makes it quite lucrative if you can reopen it. And they've got good line of sight on reopening. They're going through that process now. It will take 12 months. They're putting in place a more permeable, more flexible concrete. So the chance of the seawall collapsing again is very small, particularly all the sediment washed out of the bottom of the pit when the seawall collapsed. And so the foundations are much stronger than previous. So we actually think it is a compelling reopening of Koolan Island from a number of perspectives. Clearly, the external factor is where the iron ore price. But getting that premium obviously helps.
Excellent, guys. Last question here. A lot of my clients prefer direct equities. Would you guys ever consider doing a listed investment company in smalls or micros?
Thanks, Mark. Look, it's something we're looking at. Obviously, clients have different preferences for a variety of reasons, and access to the funds is important for us. We want to attract long-term clients, and so it's something that's under active consideration by the team at the moment.
Yeah, we have had that question quite a few times in the past.
Okay, well, stay tuned. Next edition, we might have a further development on that. Look, thank you very much for your participation today in terms of the Spheria webinar. We'll be making the Spheria webinar available on the Spheria investment website, which is www.spheria.com.au, and that should be available later today. We'd certainly like to thank you all for your participation today. If you have any further questions, please do not hesitate to contact the Pinnacle Distribution team. You can see there on the slide. We look forward to catching up with you in your office or on our next webinar. Thank you very much and have a nice day.